for Forex measured currencies. We are making our weekly Forex trading plan, and we will be speaking about the prospects for the Forex measures for the period from today until Friday. Then we will meet on Monday, November 7th, to discuss the US election and what comes next for the US in greater detail. For now, we are working in a rather short term, and it means the next few trading days. So our agenda as usually is the following. Firstly, we discuss how the market is positioned. Then we take a look at the economic calendar, at the Forex charts, and summarize all we have said, providing trade ideas. Today is the first day of November, so it is really good to see how the Forex market behaved in October and what monthly trends have developed. Here at this chart provided by Bloomberg, we can see that the US dollar was very successful in October. It managed to gain versus all other major currencies, and all the other currencies, on the contrary, have declined versus the greenback. The leader in declines was the British pound. It has lost more than 5% versus the greenback. Also, we saw a decline in Japanese yen, the euro, commodity currencies like Canadian New Zealand dollar, and a smaller but still a decline in Australian dollar versus the US dollar. US dollar index has strengthened in October, both by the calculation of Bloomberg and by other calculations. Here is the latest data on how the Forex market is positioned. CFTC, or Commodity Futures Trading Commission, provides us data on the position of large players. We can see here on the left that the aggregate US dollar bullish position has somewhat increased, though the momentum of this increase has slowed down. So the increase wasn't as big as in the previous weeks. US dollar is clearly in the bullish territory, but the pace of the large players becoming more bullish on the US dollar has become lower. And here on the right, we can see a more detailed information about how the market is positioned on the major currencies. Let's have a look at this data. We can see that the bearish euro net position has increased even more. This position is extremely large by now. And the position in British pound, the bearish position is also large, not as large as the euro, but here we saw a contraction of net shorts for the British pound, and this reflected in the fact that the British currency has actually managed to stabilize a bit versus the greenback if we look at the GBP USD price chart. Bullish position for Japanese yen has increased a bit to this level you see here, and a sizable increase can be seen in a bullish position for gold. Gold is moving in reverse direction with the US dollar, and some slight retreat of the American currency has caused the increase in gold bullish position. I can remind you that this CFTC data is summoned on the weekly basis. However, there is a time lag, so this data reflects change in the market sentiment during the week, which ended at Tuesday, October 25. So these data are a week old. However, still we can track some big changes in the market based on these figures. So I believe that it's worth watching this data every week before we plan our trades. So we have discussed that the US dollar has shown big gains in October, but if we look at the US dollar index chart, at the daily chart, we can see that last week American currency, although was more or less stable, it traded below 99 level for the US dollar index. This is the major resistance for the US currency. There was a consolidation and a tendency to get a bit lower as we have started a new week. I believe that this week is going to be rather volatile for the US dollar. We will discuss American fundamental economic factors in greater detail, but just looking at this technical chart, we can see that the decline below 98 support will open the way down to 97.60, the recent minimums of October, and also the maximums of this summer. So this is the next level probably to target for the US dollar index. So let's have a look at the economic calendar for today. We still have some important news releases today on Tuesday and other days of this week from Wednesday to Friday. There will be the meeting of the US Federal Reserve on Wednesday evening. You can see it here in the calendar, FOMC meeting. FOMC is the Federal Open Market Committee, the Fed members which make decisions on the US monetary policy. The market doesn't expect the Federal Reserve to change its policy on Wednesday. Here you can see that for the meeting on November 2nd, 2016, the possibility of a rate hike the Federal Reserve is estimated by the market as just a bit higher than 7%. This is the data from Chicago Mercantile Exchange, CME, and it reflects the sentiment of the futures market, how the futures market is pricing in the possibility of the Fed's rate hike. So nothing is expected to change in November, but in December the possibility has increased to 72.5% that there will be a rate hike to 50 from 50 to 75 basis points. And this is a significant decline. This is a significant, increase in the expectations that the Federal Reserve will raise interest rate. Earlier, some 3 or maybe 4 weeks ago, we had 50-50 layout here, 50% that the rates will remain unchanged in December and 50% that the Federal Reserve will raise rates. Now the probability of the rate hike in December has increased, and this increase was the main fuel of the US dollar's rise in October. What we have seen on this Bloomberg chart, why the US dollar has gained versus other major currencies. The main driver were the expectations of the Federal Reserve's rate hike, but not in November, in December. So when we look at the economic calendar and see this FOMC meeting, we just think, so if the market doesn't think that the Federal Reserve will move in November, then this FOMC meeting is probably not important. There is even no press conference at this Wednesday's meeting. This is partly true, but still, in my opinion, every FOMC meeting is important. The thing is that the Federal Reserve will provide us its statement on the US monetary policy, and the market will be looking at this statement rather closely in order to find some hints on what are the Fed's plans for December. Is it really so that the US central bank is moving towards a rate hike in December? All in all, as the market is now quite ready for the US rate hike in December, the FOMC doesn't need to make its statement very hawkish and significantly change what it has said in September. I can remind you that in September, the regulator said that the case for a rate hike has strengthened, but it's still necessary to have more evidence of the US economic recovery. So what it means is that probably the FOMC meeting statement will contain some mildly hawkish comments from the Fed, but the US central bank will likely still focus on the US economic data, the incoming data, and as a result, some other economic events from the US of this week may be actually a bit more important than the Federal Reserve's meeting. The meeting itself will make some impact on the market. Of course, hawkish tone of the meeting will be positive for the US dollar, while less hawkish tone will be negative for the US currency. But we recommend you paying more attention to US ISM manufacturing PMI on Tuesday, ISM non-manufacturing PMI on Thursday, and also US labor market data. It means ADP non-farm employment change on Wednesday, and surely the great source of volatility, US non-farm payrolls on Friday. And together with NFP, we will also have average earnings data and US unemployment rate indicator. Other important data releases, apart from those which come from the United States, are Australian building approvals on Wednesday, UK construction PMI on Wednesday as well, US, we have talked about US. On Thursday, Australian trade balance and the Bank of England's inflation report and meeting, and some more news from Australia on Friday, retail sales, and the Bank of Canada's Governor Paul speaking, and also Canada's employment report as well on Friday. Canada's employment figures are usually released just at the moment we have the US labor market data. So together with the US NFP, and this makes trading the US dollar Canadian dollar currency pair very, very interesting these days. So we have discussed the Fed's meeting, and let's speak a bit more about the US dollar, as it is surely the main currency which takes part in the most of the currency pairs we usually trade. So we have to have a good knowledge of the US dollar from different sides. And I would like to point your attention to the US GDP growth rate. The figures were released on Friday, and the figures were bright. US economic growth accelerated from 1.4% in the second quarter to 2.9% in the third quarter. The data for the third quarter, this 2.9%, almost 3% growth of the US economy, is an advanced data. So 2 more times this data will be revised, but still the figure looks very, very good. And we can see that it's been really a while, several years, until we had such strong figure of the on the quarterly basis. So this figure surely act in favor of stronger dollar and US Federal Reserve's rate hike in December. Also, if we speak about the US labor market, it is an important it plays an important role in the Fed's decision. And here we have another interesting chart from Bloomberg. We can see that the orange here indicates the actual payroll change. So how it indicates the amount of non-farm payrolls NFP by month. And the blue here is the trend rate. As we know, UBA economy needs to end about 50 or 110,000 jobs a month to keep the unemployment rate steady. And actually, US NFP growth has been exceeding this blue columns for most of the months of this year. Only in May we had a very low NFP, but all in all, during summer and during other months before May, the pace of jobs gain in the United States was rather high. And this is another argument that December is really a strong option for the Federal Reserve to raise interest rates. Why do we speak about December and not November? The answer is very simple, and we have already spoken a bit about it. It's the US presidential election. At some point, it seemed that Hillary Clinton was far ahead of Donald Trump. Hillary Clinton is the Democratic candidate, and Donald Trump is the nominee of the Republican Party. Still, now the situation looks much more uncertain. Let's have a look at the latest opinion polls. They have narrowed after news on Friday that FBI has reopened investigation into Hillary Clinton's use of private email server case. This news has shaken positions of Hillary Clinton a bit, and we see that according to the national polls, her lead over Donald Trump isn't really that big. On this chart, we can see that this lead has narrowed in the past week. Also, I'd like to point your attention to the fact that the US election system is kind of complicated. So the national polls don't reflect the full amount of this complication. There are some entities which take part in the election in the so-called battleground states. So the process of election isn't direct. There are some intermediaries there, and it will depend on how the votes will be distributed in these intermediate entities and in these battleground states. So if we look at this complex data, the lead which Hillary Clinton is currently having over Donald Trump is even more uncertain. What it all means? It means that the uncertainty factor is really high, and the Federal Reserve won't raise interest rates until we know who is the president of the United States for the next term. So after election passes, after November 8th passes, then the Federal Reserve will probably be able to tighten monetary policy in December. As we know, monetary policy tightening is a kind of restrictive measure which curbs activity at financial market a bit. So this is not the move the policymakers would like to make in the situation of uncertainty. They certainly wouldn't want to bring more stress to financial markets. As a result, I think that traders can be pretty certain that the FOMC meeting will be non-event, but we'll get probably some very minor changes in its statement. And once again, I repeat this idea that this non-event FOMC will make us more focused on the other US economic data releases. Surely MFP on Friday will make the markets rather volatile, as it usually does. Probably this won't have a very big long-term impact on the US dollar, as it is likely that even if the Fed does raise interest rates in December, further pace of monetary tightening in the US will be rather slow, and the overall potential of the US dollar to strengthen is limited. But in the short term, in the very, very short term, as we will be trading on Friday, surely we have to be prepared for swings in the currency market and use the risk management techniques accordingly. I would also like to show you the last chart in my presentation, and then we are going to the MT4 to look at the currency pair charts. Here we have some data about the British pound. It says us that British economic data have been steadily better in the last few months. However, we see that British pound is continuing to decline, and that this positive economic data from the UK doesn't really make the market players buy the British pound. Why is it happening with the British pound? Well, the main reason are concerns that are created by the approaching Brexit. These Brexit fears seem to prevail over the UK's relatively bright economic releases. We know now that British government hasn't still disclosed the terms it wants after the nation leaves the European Union, and this lack of information from the British government creates a situation of uncertainty. Also, we didn't know whether the Bank of England's governor Mark Carney would stay at his current position for the full term or not, and only today there was confirmation that Mark Carney will remain in the Bank of England until June 2019. So he will see Britain through Brexit and continue leading the UK central bank at this difficult time. But still, Carney won't serve his full 8-year term. British pound gained a bit on relief that Carney will help the Bank of England during Brexit, but it wasn't a big game changer for the pound and didn't switch the situation in the currently very positive manner. So this was theory. Let's now have a look at the charts to speak more about practice. We start with euro dollar, and usually we start with weekly chart. We can see that the weekly candle formed last week was green, that means bullish, and it engulfed the body of the previous bearish candle. However, it didn't engulf this candle's upper shadow, so I believe that we will have probably a bit more of correction in the euro dollar to the upside, but this correction should be limited. On the weekly chart, we can see that resistance is located in the area of 1.11, 1.1120. This is the 50-week moving average and also the previous support line and now resistance line, which is connecting the minimums of November 2015 and minimums of this summer. Now we switch to the daily chart. We have the same resistance line here, and also we have an indicator called weekly pivot point. This indicator is very valuable with the weekly forecast. And we can see the blue line, which is located at 109.40. As long as euro dollar is trading above this line, it means that the near-term outlook is more bullish, and that the currency may actually rise to the next levels, so-called pivot resistance levels. They are located at 1.1033, 1.1080, and 1.1174. These are the pivot weekly resistance levels. We can see here this line is the resistance line from 2015 lows, about which we have spoken, and also the pair has come close to another resistance line. It connects the minimums of 2016, and it is located in the area of 1.1050, which is also a resistance for the euro dollar. If we look at the moving averages, we can see that the 50-day moving average went firstly below 200-day moving average and then below 100-day moving average. As a result, these moving averages create a resistance above 1.11, and they add to the view that the ability of the euro to strengthen will be limited. If we look at the fundamental factors for the euro and try to see whether the single currency has its intrinsic strength to get higher versus the US dollar, then we can see that data released in the euro area last week were mixed. There were positive PMIs and German IFO business climate, but a lower German consumer climate and French statistics. The most important data from the euro area this week were already released on Monday, and we can see that the region's flash inflation data for October and GDP for the third quarter didn't show any positive surprises, and as a result, traders won't think that the European Central Bank has many reasons to reduce the amount of its monetary easing. As a result, factors for the euro to strengthen are really limited. It more comes down to what is moving the US dollar this week, not the euro. And here also some small decline of the US dollar, some small advance of the euro is possible, but our ceiling lies around 1.1140. The moving averages are on the daily chart, and at this point we believe that new sellers will re-emerge for the euro dollar. As for support levels, they are located at 109.40, 108.90, and 108. This is what we have in mind for the euro dollar. One look at the 4-hour chart. At the 4-hour chart, the pair has managed to rise above the moving averages, the 50 period one and 100 period one. These are simple moving averages. And the next target is 200 period moving average around 1.1090. Support will be provided by 100 period moving average at 109.76. Let's see what British pound has in mind for us. Here we can see that on the daily chart there is a long-lasting consolidation. Same on the weekly chart, not really many hints here. The indicators though are in the oversold territory on the weekly chart and kind of recovering on the daily chart, though we don't see any strong recovery momentum here. The moving averages continue to slope to the downside, but they are rather far from the current prices, and the possibility of recovery still exists. Still, also, we don't see much bullish momentum on the 4-hour chart. Here, the moving averages are getting more and more horizontal, and it seems that the market is in the wait and see position, unwilling to make big positions. This week, the Bank of England will meet on Thursday. All in all, better economic figures released so far made the market think that the central bank won't do additional policy easing. The Bank of England's Governor Mark Carney has recently said that the central bank's efforts had a positive impact on the Britain's economy and that there were limits to the central bank's ability to ignore the effects of depreciating pound on inflation. The regulator will also release quarterly inflation report with the new quarterly projections for growth and inflation. This data will be really important for the market. All in all, we expect that the Bank of England's meeting will be rather non-committing for the Bank of England. We probably won't have any new monetary easing, though the Bank of England would probably remain cautious and still have the option of increasing monetary stimulus in future if needed. So some mild negative reaction is possible in the British pound. So far, expectations that the Bank of England will remain on hold provide some support for the sterling, but Brexit fears don't let the British pound to show any significant recovery. We will be also watching UK PMIs, which are due this week, and this is what should be looked at from the fundamental point of view. All in all, we can see that the daily chart, British pound has made a lower high last week, and a resistance which is located in the area of 1.2270, 1.23 looks rather strong. It closed below 1.21 mark will confirm the resumption of the downtrend and open the way for a decline to 1.20 and 1.19. Note, though, that the amount of short positioning on the British pound is very high, and short covering may trigger a sharp short-term rebound of the British currency. But taking into account the fact that last week there was some decline in pound shorts, it was moderate. Maybe this short covering won't be a serious factor. If the Bank of England sounds less and less dovish, then yes, there is a possibility that a short-term spike in British pound may happen because of this short positioning. In this case, the bigger resistance for British pound is at 1.25, and I don't believe that bulls will be able to push the pair significantly above this level as long as there are still serious concerns about the British future and concerns related to Brexit. So we will have a look at the mentioned support levels. Here we also have this weekly pivot indicator. For now, British pound is trading at the positive territory as the indicator is at 1.2181 levels. You can see this indicator also provides us support and resistance levels. Resistance is located at 1.2280, 1.2370 and 1.2470. While further support is at 1.2091 and 1.1992. I do recommend you to use this indicator. We now come to US dollar Japanese yen currency pair. And here I'd like to point out that we did have a news event today. It was the Bank of Japan's meeting, and the results of this meeting were the following. The Bank of Japan didn't change its monetary policy. It held off on expanding monetary stimulus. At the same time, the central bank pushed back the timing for hitting its inflation target. It is somewhere in fiscal year of 2018 now. The central bank has said that it will keep policy unchanged unless there are some severe shocks. And as far as we can judge, unless the dollar yen moves somewhere closer to 95 yen per dollar, then the Bank of Japan and Japanese government will do nothing at the Forex market, nothing to change this situation. However, it is worth noting that Bank of Japan has made an emphasis on the downside risks which exist for Japanese economy. And it means that still the central bank is committed to its loose monetary policy, and this factor is acting in favor of the US dollar versus the Japanese yen. We can see that dollar yen is currently trying to get above 105 mark, which is our main resistance. If dollar yen managed to settle above this level, we will get higher to our next resistance levels. If we look at the levels provided by the weekly pivot indicator, we can see that these levels are 105.59 or 105.60, 106.46, and higher above 107. Support is located at the weekly pivot of 104.65 and lower at 103.77, 78 and 102.85. All in all, at the 4-hour chart, we can draw a support line through the recent lows. Actually, the support line which goes back to the end of September, and prices are still holding above this level. As long as they are, it means that the outlook and the overall trend, the medium-term trend for dollar yen is bullish. Last week, dollar yen managed to close above the previous resistance, which was situated in the area of 104.30. So the pair has managed to fight its way above 104.30, and even though its movements are consolidative, it slowly but surely is moving to the upside. For now, we can see that the 50-day moving average is ready to cross 100-day moving average at the daily chart, and this is a bullish signal saying that bullish positions are currently prevailing for this pair. The main news which took place in Japan have already passed the Bank of Japan's meeting, so now the main driver for the pair will be the meeting of FOMC and the US data releases. Non-farm payrolls will be important for dollar yen, and probably dollar yen is the best pair to trade on the US NFP release. Also, we had some positive figures from China. Chinese manufacturing PMI rose to the highest level since July 2014, and such positive figures from China make the market more positive and improve the market's risk sentiment, and the refuge currency, which is Japanese yen, is thus declining versus the US dollar. This is another factor in favor of US dollar Japanese yen currency pair, but we don't expect any big gains here. And I'd like to point out that any move of the dollar yen to the upside will be very gradual. And of course, we will be watching the mentioned support levels and mentioned resistance levels in order to build our trade on the daily basis. Now, a couple of words about Australian dollar. Australian dollar is once again close to 0.77 level. This level represents the obstacle which prevented the pair from going higher since the beginning of August. Plenty of weeks have ended below this line, despite the fact that the market was willing to test these higher levels. What happened in Australia? There was also a meeting of the central bank, the Reserve Bank of Australia, and after this meeting, the expectations of a near-term rate cut in Australia have declined, and also prospects of a rate cut in 2017 have declined as well. So comments of the Reserve Bank of Australia were rather positive, although the market didn't expect the RBA to cut rates as inflation in Australia has edged to the upside. Still, the fact that the central bank doesn't seem to be very concerned about relatively low inflation has diminished the possibility of a rate cut, and increased demand for Australian dollar, increased the market's willingness to search for higher yields in Australia. This is why we see the currency move towards 0.77. However, I would like to recommend you staying away from bullish position on Australian dollar, US dollar, as long as we don't make sure that Australian dollar, US dollar has managed to settle above this 0.77 mark. Last week's high, which can be seen on the 4-hour chart, was lower than the high of the previous week. And this create also doubts that we will see a strong recovery in Australian dollar. So it is more sensible and more safe to wait until we have the confirmation that we have broken above this resistance. I think that if the situation is really changing to a more weaker US dollar versus commodity currencies, then we will have plenty of time to join this move of Australian dollar to the upside, as we see that there was a large consolidative pattern in Australian dollar US dollar, and the break above its upper border will open a big scope for move higher. So don't worry that you'll get late to buy Australian dollar. At this point, buying is not worth it, in my opinion. The risks are too high. All in all, we have still lots of data releases from Australia this week, trade balance, retail sales, which will also have an impact on the pair. We also have many releases from the United States, which are going to bring significant volatility to this pair. So I believe that we will have plenty of opportunities to trade. On the 4-hour chart, we can see that the moving averages are currently below the price, and they have come together in a kind of consolidative sign, and this increases the risk that Australian dollar will have to return to the area of these moving averages. The pair is currently overbought. A stochastic indicator is above 80 mark and may reverse to the downside soon. So let's have a look at the 1-hour chart. Here the pair is also quite overbought. The moving averages may show some change, but for now the longer term moving averages, the 200 period and 100 period, are still horizontal. So still it is likely that this move will come at least to the middle grounds around 0.7630, 0.7615 until we see some further developments in this currency pair. On the downside, support levels are located at 0.7650, 0.76, and 0.7575. Support levels provided by this 2016 support line are also very strong, so we don't recommend to sell Australian dollar past these levels. If we remember last week, I have told you that we will be trading in range between 0.77 and this support line on the downside, which was in the area of 0.7560, and this is exactly what we have seen. Australian dollar has some further scope to remain between these levels, which are limiting these currency pairs as on the upside and on the downside as well. New Zealand's dollar has also gained on Tuesday. The currency was supported by good Chinese manufacturing data. However, we also see that this currency as well has obstacles in form of moving averages at 0.7195 and higher at 0.7240. These are resistance levels, while support is located around 0.7130 ahead of 0.7065. This is the support line of the uptrend channel. And a couple of words about gold. The assets seem to regain control over 200-day moving average and is now trying to get higher. Our bullish target lies at 1,300. This is the target. This is 50-day moving average. And here we have some negative cross of the moving averages. So this is where we will fix our target, our position. We will take profit on gold bullish position here. All in all, gold is as well supported by the market's physical demand, as there is the season of holidays and weddings in India, which is the world's biggest consumer of gold. And also as the US dollar has retreated in the past week and weekend a bit, gold is trying to recover some of the losses it made at the late of September and the beginning of October. This is our target, and support is located around 200-day moving average in the area of 1,275. This is the support. So let's now make a conclusion of what we have spoken about today. The US dollar. The main events of this week for the US dollar include the meeting of the Federal Reserve and the releases of the US economic data like ISM manufacturing and non-manufacturing PMIs, as well as labor market data, ADP employment report, and NFP report on Friday. The Federal Reserve is expected to raise interest rates in December, but not expected to move this week at November 2nd meeting. So the markets will be looking at the FOMC monetary policy statement for some clues that the Federal Reserve is getting more ready for a rate hike in December. The Federal Reserve will unlikely significantly change its statement from September. So the main focus of the market will be on the US economic releases. The US dollar thus will remain extremely data dependent. We saw that the US dollar index is about to correct to the downside, and here the targets lie around 97.60. As for the other currencies, the euro is currently recovering versus the greenback and has potential to get higher up to 1.1130. The euro's potential for a recovery should be limited by this area, as the single currency doesn't have many reasons to strengthen on its own, as the European Central Bank is still believed to keep its monetary policy extremely loose. The British pound is also trying to recover versus the US dollar, though here we can see that trading is taking place in a much more narrow ranges, and the main negative factor for the British pound, which is limiting the currency's growth on the upside, is uncertainty caused by Brexit, and this uncertainty will likely prevail over the British pound despite more positive UK economic figures. So we will watch resistance at 1.2270, 1.23, ahead of 1.25, which will be reached increase of a very negative US non-farm payrolls maybe, and some hawkish commands of the Bank of England's meeting, which will also take place this week. Otherwise, below 1.2180 or 1.21, we will focus on decline to 1.20 mark. Dollar yen has potential to move higher a bit, but its advance is expected to be very, very slow. For now, the pair is trading above resistance line from the end of September. Decline below 104.65 will open the way down for a correction to 104.30, 103.80. This will be the targets on the downside. On the upside, above the current level, we will be watched for a moderate advance to 105.60 and maybe higher to 106.46 if the US data really surprise to the upside. Here, the policy of the Bank of Japan remains unchanged. Generally, this policy has a very slight bullish effect on dollar yen. It's not a big driver for the pair to the upside, only a slight plus for dollar yen. So the main thing to watch here is the policy of the Fed and US economic data, which will determine whether the US dollar has strength for further growth. And finally, Australian dollar, US dollar has managed to strengthen as the Reserve Bank of Australia sounded more positive than was expected. But we still have to wait until the pair settles above 0.77 mark in order to make any significant bullish positions. For now, the risks of return to 0.7615 prevail, and below that support will be 550. This is it. This is all I have to offer you today. Next time we'll see each other will be definitely on Monday, November 7th, just ahead of the US presidential election, and then we will discuss how to prepare your trading account for such an event as the election of the US president. This will be our central topic. I thank you for your attention. I hope that you have learned something positive and that this presentation was useful to you. I wish you good luck in your trades and remind you that it was Elizaveta Belugina, head of analytical department at FBS, and our next webinar will take place on Monday, November 7th. Good luck to you and see you next week. Bye.